Welcome to the Deep Dive. Today, we're going to take you on a journey
Okay.
exploring the potential of the Indian stock market, specifically for long-term growth.
Yeah.
You know, you want to build a strong financial foundation for, let's say, someone young,
Right.
maybe just starting out.
Right.
We'll cover the basics,
Yeah.
but also uncover those aha moments that'll really make this all click.
Awesome.
To guide us through this exciting landscape, we have our expert
Hi.
who can really break down even the most complex concepts.
I'll try my best.
All right, let's dive in. First things first, what exactly is the stock market?
Yeah.
It sounds intimidating, but it doesn't have to be.
It really doesn't. Imagine owning a tiny piece of a company that's doing really well, like maybe a booming tech startup or a popular clothing brand. As that company grows and becomes more valuable, your piece does too. That's the essence of stocks.
So it's not just numbers on a screen. It's owning a little slice of something real.
Exactly.
Now, we hear a lot about stock exchanges, indexes like the Sensex and Nifty. What are those all about?
Think of stock exchanges as like bustling marketplaces where these pieces of companies, the stocks are bought and sold. In India, the big players are the Bombay Stock Exchange, BSE, and the National Stock Exchange, NSE.
Okay.
Now, the Sensex and Nifty are like scoreboards,
Okay.
tracking the performance of a bunch of top companies on these exchanges. They give us a snapshot of how the overall market is doing.
So if someone says the Sensex is up,
Yeah,
it generally means the market is having a good day and vice versa.
got it.
Exactly. You mentioned owning a piece of a company.
Yes.
What are some ways to actually do that besides buying individual stocks?
There are actually quite a few options, each with its own level of risk and potential reward. You've got bonds, which are like lending money to a company or the government
Right.
in exchange for interest payments. These are generally seen as less risky than stocks.
So less risk, but probably less potential for those big gains too.
Exactly. Then there are mutual funds and ETFs. Imagine a basket carefully curated by experts, filled with different stocks or bonds. This helps spread the risk and can be great for beginners who want diversification without picking individual stocks.
Sounds like a good way to get started without feeling overwhelmed.
It is.
Now, you mentioned starting early. Why is that so crucial, especially for a young person?
That's where the real magic happens. The magic of compounding. It's not just about the money you put in.
Okay.
It's about the returns you earn on that money, which then generate more returns. It's like a snowball effect.
Okay.
One of India's most famous investors, Rakesh Jhunjhunwala, started young and built a massive fortune, proving the power of compounding in the Indian market.
So it's not just about being a financial whiz.
No.
It's about giving your money time to grow. That's really eye-opening, especially for someone starting young. They have time on their side,
Right.
even with small amounts.
Absolutely. And the earlier you start, the more time and the money has to compound.
Yeah.
And potentially grow exponentially.
Yeah.
It's like giving a small sapling the chance to grow into a mighty tree. Time is your biggest ally.
This is fascinating. So if we were to build an investment plan from scratch, starting when a child is really young, how would that look?
Building a portfolio for growth from age 1 to 18 involves strategic shifts as the child and their risk tolerance evolves.
So a roadmap tailored to different age groups.
Yeah.
I like it. What kind of investments would you recommend for the youngest one, say between 1 and 5 years old?
For this age group, stability and steady growth are key. Think index funds, ETFs, tracking the Nifty 50 and large cap stocks, those big established companies with a proven track record. We're talking about the likes of TCS Infosys, HUL, and HDFC Bank. These companies have weathered many storms and continue to be major players in the Indian economy.
Makes sense. Solid foundations are important when you're just starting out. What about as they get a little older, maybe 6 to 12?
Yeah.
We start taking a few more risks?
Absolutely. We can start diversifying a bit more, adding some spice to the portfolio. Sector-based mutual funds focusing on high-growth areas like technology or healthcare could be good options.
Ooh, now we're talking. What are some examples of sectors that might be particularly exciting in the Indian context?
India is undergoing a digital revolution, and the technology sector is booming. Think about companies like Infosys and Wipro, major players in IT services,
Right.
or even startups like Paytm revolutionizing digital payments. Healthcare is another promising area, with companies like Dr. Reddy's Laboratories and Sun Pharma catering to a growing and aging population.
So we're not just chasing returns. We're investing in the growth story of India itself.
Exactly.
That's pretty cool.
Yeah.
What about when those kids become teenagers?
Yeah.
Are they ready to pick their own stocks?
Well, maybe not quite ready to run their own hedge funds.
No.
But this is the time to introduce them to the world of individual stocks and the concept of risk versus reward. They can start exploring booming sectors like renewable energy, especially with India's push for sustainability.
Renewable energy. Any specific companies that come to mind?
Aether Energy is a fascinating example. They're making waves in the electric vehicle market, and as India shifts toward cleaner transportation, companies like Aether could see explosive growth.
Interesting.
Of course, this comes with higher risks, so proper research and understanding are crucial.
By 18, they'll be ready to take charge of their own financial future.
Right.
But let's talk numbers for a minute. What kind of returns can one realistically expect over this 18-year period? I mean, are we talking about enough to make a real difference in their lives?
Absolutely. Let's paint a few scenarios, assuming we're investing a modest €1,000 per month. With a conservative approach aiming for 12% returns, the investment could grow to 7 or 8 lakh by the time the child turns 18.
Okay.
That's a solid foundation for their future.
That's impressive. But what if we bump up the risk a bit?
A moderate approach targeting 14% returns could potentially see that same investment grow to 10 or 12 lakh. Imagine the possibilities.
Wow.
College tuition, a down payment on a home, or even seed money for their own entrepreneurial ventures.
Now we're talking life-changing money. And what if we go for a more aggressive strategy?
If we aim for 16% returns with a higher risk portfolio, that 1,000 monthly investment could potentially balloon to 15 or even 17 lakh.
Okay.
That's a significant sum that could truly set them up for success.
Those numbers are really exciting, but we have to acknowledge that the stock market can be volatile.
Yeah.
How do we manage risk and make sure our listeners are making smart choices?
You're absolutely right. Diversification is key. Spreading investments across various sectors. Technology, healthcare, FMCG.
Good.
Consider companies like Dr. Reddy's, Sun Pharma, Dabur, Asian Paints, and Titan. They represent a mix of stability and growth potential and can help mitigate the impact of fluctuations in any one sector.
So don't put all your eggs in one basket, as they say.
Exactly. And remember, avoid trying to time the market.
Yeah.
No one can perfectly predict the ups and downs. Consistent investing over time is generally the best approach.
Solid advice. Now, before we get too carried away with the excitement of potential returns, we have to mention taxes.
Oh.
How do those factor into the equation?
You're right. Taxes are a reality of investing, and understanding their implications is crucial. For instance, long-term capital gains tax, LTCG, applies to profits from selling assets held for more than a year. Dividend tax is another factor to consider if you're investing in stocks that pay dividends.
It sounds like there are some complexities there, but I'm guessing there are resources and tools available to help navigate those tax implications.
Absolutely. There are many online resources and financial advisors who can provide guidance on tax-efficient investing strategies.
That's reassuring. It's important to know that you don't have to figure it all out on your own. Now, it's worth noting that stocks aren't the only option for saving for a child's future.
Right.
What other avenues might our listeners consider?
There are several alternatives, each with its own advantages and disadvantages. The Public Provident Fund, PPF, is a popular choice in India, offering low-risk, tax-free returns and a long investment horizon. It's a great option for those seeking stability and security. So a safe bet, but maybe not as much potential for high growth.
Exactly. Then there's the National Pension System, NPS, designed for retirement savings, offering tax benefits and exposure to a mix of asset classes. And of course, there are education plans offered by insurance companies specifically for a child's future education expenses.
It seems like there's a whole world of options out there.
There is.
How does someone choose the right mix for their situation?
That's where financial planning comes in. It's about understanding your goals, risk tolerance, and time horizon. A diversified approach often makes sense, combining the growth potential of stocks with the stability of other options like PPF or NPS.
It sounds like there's no one-size-fits-all answer when it comes to investing.
Yeah.
It's about finding the right balance
Right.
for your individual needs and goals.
Exactly.
But if we zoom out and look at the big picture, what's the key takeaway for our listener who wants to build long-term wealth in the Indian stock market?
I think the biggest takeaway is the power of starting early.
Even small amounts invested consistently over time can grow significantly thanks to the magic of compounding. It's like planting a seed that with time and nurturing can flourish into a mighty financial tree.
So it's not about being rich already.
Yeah.
It's about making smart choices early on and letting time do its work.
Exactly.
And it sounds like we don't have to be financial gurus to get started. There are resources and tools to guide us along the way.
Absolutely. There are tons of online resources, financial advisors, and even educational programs designed to help people of all ages understand investing. Don't be afraid to ask questions and seek guidance.
That's encouraging to hear. Before we wrap up, I want to leave our listener with one final thought-provoking question.
Okay.
Think about the future. What sectors excite you the most? What industries do you believe will shape the world in the years to come?
That's a great question. For me, the intersection of technology and sustainability is incredibly exciting. Think about renewable energy electric vehicles, artificial intelligence, and even space exploration. These are areas with immense potential to not only generate financial returns, but also to create a better future for everyone.
That's a powerful thought. When we invest in the stock market, we're not just buying shares, we're investing in ideas and innovation in the future itself.
Yeah.
It's about finding companies and sectors that align with our values and our vision of the world we want to create. Well, thank you so much for sharing your expertise and insights with us today.
It's been my pleasure.
It's been an incredible journey through the world of the Indian stock market. And to our listener, remember, knowledge is power. The more you learn, the more confident you'll become in making informed financial decisions. So keep exploring, keep learning, and keep that financial tree growing strong. Until next time, happy investing.